Hello, hello, Velocity Banking students, Kingdom citizens. How are we doing today? God bless you if you're in the house. I see we've got 11 people already tuned in, and I'm sure more will be hopping in any minute. Get your notes together. All right. Be prepared. Drop your questions nice and early so that when I'm finished with my lesson, I'll come right back to you and we'll get your questions answered. Today's focus is primarily on high cash value life insurance today. And my goal is to go probably till about 1:30. It's 11:30 a.m. Eastern time where I'm at. So it might be a little bit earlier for you, but roughly an hour and a half, 2 hours. Have some fun with you guys. Answer a bunch of questions. Get this thing going. Hello, hello. Hello, modeling. Veronica. Hello, Amanda. Will this be available later? Yes, it will. I'm going to keep this public. Usually what I do is I will take the video down, edit it, make it pretty, and put it back up. But because this is it's going to be really focused on one whole topic, I'll just keep it up. I'm still going to edit it, make it pretty, because it'll take out all this stuff that we're doing right now before we get actually started. So when you do actually rewatch it, it'll be a little bit more cleaner. Hello, hello, Hector. Hello, looking forward to learning about insurance. Yep, today is going to be very, just really transparent. My goal, your personal finance geek of the 21st century, Denzel Rodriguez, my goal, your Kingdom citizen, is to just show you my current journey with high cash value life insurance. I want to show you pretty much everything I've learned so far, the things that I haven't learned, things that I want to learn, the things that I, would like to explore. I want to reveal the playing field, right? I want to show you who are the players in this life insurance space so that you, as an educated customer, educated client, prospect, interested individual, can navigate the playing field and go straight to exactly what it is that you want to do, right? And then find someone that's a player, or what we could call an insurance agent, that can help deliver exactly what it is that you want and not what they want. Right? I want to remind you that you, as the prospect, the interested, individual, you want to remain control of your original intent of what it is that you want to do, right? So if you're saying, hey, I want to get into this life insurance space, I want to maximize on cash value performance, I want to be able to use this policy as a means to store my savings, maybe my tithings in a year, certain expenses I want to run, or maybe I want to specifically use it to pay off debt and then repurpose it later on. You want to be very clear. You want to lay out your goals when you're talking to your agent, to your insurance agent. So we got 51 people in the house. Hello, Sharonda. How are you? Let's see. Hello, Robinson. Shell. What strategy ideas to put more money in the policy? We will go over that. Hello, Kingdom. What's the best strategy to tap into my 401k? I'm assuming? Question mark. We'll get into that. Hello, Lauren. Working on my policy as I text with Brandon from IBC got approved yesterday. I hope they gave you the credit. I'd like to review my policy with you if possible. Thanks. Yes, more than happy to, have a conversation if you are an individual that went through IBC Global, right? And when they asked you, oh, how'd you find us? And you mentioned my name, just by mentioning my name, or obviously if you use my link, I get tagged automatically, so you don't have to worry about whether I get paid or not. Even if I didn't, it wouldn't be the end of the world. IBC Global, Steve Parisi, Brandon, Phil, Samantha, Stephanie. These are all insurance agents at IBC Global that I have, good relationships with. Being that I never met most of them, I've only met Phil, Dara, and Steve Parisi in person. But everyone else over at IBC Global, super nice, super transparent. They just give all the information. They've got a YouTube channel just like I do. And, we have a very, very nice partnership together where everybody wins. The client wins, agent wins, the insurance company wins, everybody wins. So yeah, if you are an individual that has an infinite banking policy through IBC Global, whom I'm partnered with, and you told them to tag me on your policy, more than happy to have a conversation. I'll send you a link, email me, right? And I'm more than, and what I do as well is like once a month I'll request from them all the policies that they actually closed on my behalf, because I brought you to them or I may have referred you to them. I give those people access to my course so that you can kind of get a little bit of both, where you see the velocity banking side, the infinite banking side, how they can kind of merge together, do private live streams, Q&As, things like that, to keep you active with your policy. I would say the easy part with high cash value life insurance is funding it. That's like the easy part, it's just getting it funded, right? Even designing it, that's the easy part. The tough part is maintaining it, I think, having a strategy to go along with it to actually maximize the account, right? So let's see, how do I want to do this? So what I'm going to do is I'm going to show you guys my own policies first, right? So I'm going to stop looking at the comments for right now, but feel free to drop your question now in advance. You might have someone in the chat room that answers it, right? But later on, I'm going to leave time for some Q&A, and I also want to bring people on the live stream. If you're down, that'll be fun. I want to bring you on the live stream because this platform that I use, Ecamm Live, they just created a, what is it called? It's called interview mode, and it's super cool. Basically, I can bring guests on without using Skype anymore. So I think it's going to be a little bit cleaner now with audio and whatnot. So let's see. I'm going to share my screen. I actually did a live stream last night with a private group, and they were super nice. So I actually kind of already typed up a bunch of stuff for you guys. I'm going to go ahead and share my screen now. If I can do that, it lets me. We'll get this show on the road. All right, let's see. There we go. Awesome. Let me know if you guys can see my screen nice and clear, no issue. If you want, I can blow this up a little bit. Make it a little bit bigger. Go like that. All right. So, and you're gonna have to forgive me. I'm actually at my house, and I've heard at least like 10 car alarms go off today. So I'm like, oh my God. On the day I want to go live, all these car alarms want to go off. All right, so the topic today, everyone, is high cash value life insurance. All right. Very first thing we're going to go over so that you can understand the playing field is the terms. Okay. Really, mainly the marketing terms that is used by insurance agents. Okay. So I want to distinct marketing terms from the actual terminology from the insurance company itself, just so that you don't get confused and think that, oh, these are different things. No, they're all the same. It's just marketing terms that every YouTube channel or website will use to distinct themselves from everyone else. You know, it adds a little more uniqueness to it, right? So high cash value life insurance is I would say the actual term, right? At its core, it's also called whole life insurance, right? The other product that is commonly known is index universal life insurance. Okay? Universal. Did I spell that wrong? What the hell? All right. Index universal life insurance. These are the terms from the insurance company itself. Right? We'll go nice and smooth with this. All right, so terms from the insurance company. Whole life insurance, index universal life, high cash value life insurance. That's what is used by the insurance company. So if you're looking at Lafayette, Penn Mutual, Omaha Mutual Trust, Mass Mutual, Guardian, New York Life, you know, name any company, you'll see those words on their site. The marketing terms that are used by agents to distinct themselves from everyone else, right? You've got infinite banking concept, become your own banker, cash flow banking, private banking. Let's see, you've got be your own banker, right? Be your own banker. You've got, what else is out there? And you guys can comment the things that you've heard before. You know, I've heard this, tax-free banking, banking with life. I've heard that. I've heard bank on yourself, right? Then you've got family banking, right? These are all marketing terms. They all mean the same thing for the most part. The distinction is between whether you're working with an agent that is selling you a whole life insurance policy or a indexed universal life insurance policy. Okay, between the two of them, they're quite similar, right? They're both permanent life insurance policies that you pay for your whole entire life. They both come with riders, like term riders, waiver of premium, accelerated death benefit rider, terminal illness rider, right? Depending on which company you're going with and how the agent designs the policy for you. When you step into the space of, you know, high cash value life insurance, or you could call it the infinite banking concept, which I would say this one is probably used the most. Infinite banking concept, probably used the most because of this gentleman right here, Nelson Nash, right? And I would say his books are probably the most popular books out there regarding this concept. He's also known as the godfather, right, of infinite banking. So some people call him the source, right, of the concept, because I think maybe he was the first person to start teaching the concept, right? So you have agents that are primarily salesmen, right? Then you have teachers. Then you have the doers, okay? So a salesman, if you're just dealing with an agent that is selling you a life insurance policy, it could mean that they do not know how to teach it to you. They're just selling you the concept itself. They haven't really learned it themselves enough to do it long enough to experience it, to get results. So they're just selling you it. Nothing wrong with being sold something, right? I believe in sales. That's what drives economies. So, you know, you either sell or be sold, right? It's pretty simple. So nothing wrong with being a salesman, but I like more. I like someone that can sell me something. I like someone that can teach me something while they're selling me. And I like it if they are doing what they are selling me. So you kind of want to have all three, right? You want to have the doer. Ideally, you want to have a teacher. And you want them to, you know, sell you something that is effective, right? Ideally, that's what I would want, right? As a customer, not just as an agent now, someone that is a, you know, I would consider myself a salesman, a teacher, and a doer. I have 2 policies. I'm doing this right now, taking my best shot at teaching the concept and trying to, you know, help most of you guys. And then I'm also selling it, you know, on the back end. There's a link below in the description. Boom, it'll take you right to an agency, right, that can help a mass amount of people. Me personally, I will do maybe a couple of policies a month personally, because the way that I operate, I do not work with everyone. Number one, just because I can't, it's impossible. Too many, you know, people, so to speak. And this will be a problem that every business owner will face, is when demand is higher than supply, right? So I don't have enough supply personally to meet the demands. So that's why I partnered with an agency who can handle that demand. And that's IBC Global, right? For me. Now, there's plenty of agencies out there, right? And we're going to go over the players. So I might as well go into that right now. Who are the players, right? And I'm just going to go with just sharing with you the players that I know so far that have credibility, that are not going anywhere, right? Me personally, I feel like these people are passionate. I feel like they love what they do. I don't think they're going to retire anytime soon, right? And they're not going to switch up. Like one day they're selling you infinite banking, and then tomorrow they're, you know, doing real estate investing. And then the next day they decide to become a truck driver. And then they want to study, you know, so they're all over the place, right? Ideally, me personally, I like to work with someone that has a passion in that one specific area. You know, maybe they have a couple of businesses going on, which is totally fine. But, you know, I want to make sure that whoever is my agent is going to stay my agent until death do us part, kind of like a marriage. This is why I think it's very important that as you guys are doing research and you're looking across the internet, that you want to evaluate who you're going to go with based on these parameters here. And you can add to these parameters, right? But ideally, you want to consider some of these things, just so that, you know, you're really confident that no one's going to do you wrong, and there's an infrastructure, there's a strategy in place to help you along the way. So, who are the players? So the first one, because I know them, IBC Global. So this is not in any particular order. This is just I'm going to go based on my relationship with each of these people, right? So IBC Global is a company run by Steve Parisi, who's the owner, has multiple agents out of Pennsylvania area, and they have a YouTube channel as well called IBC Global. Then you have Wealth Nation. If you guys seen, I've done 2 collaborations with Wealth Nation so far. One on their channel, one on my channel. So if you were to type in Wealth Nation, you'll come across a couple by the name of Carmen and Darius. Okay. What I'm not going to do is write their names. I don't know if I'm allowed to do that or not with YouTube. I don't want to get in any issues. So I'm just going to name their companies or their YouTube channels, and then you guys can, you know, do your research and, you know, find that individual that you want to work with. So Wealth Nation, they do sell high cash value life insurance policies. They specifically stick with whole life. Okay. IBC Global specifically sticks with whole life. They do not sell index universal life insurance policies. There are some, not many, but there are some insurance agents that do both whole life and index universal life. One of those individuals, take the bold off here, and forgive the noise in the background. That's construction going on in my area. So, shoot, I forgot his YouTube channel. I think it's, let me look it up real quick. I think it's Cash Flow Pro. Or is it? Oh yeah, no, I had it right. It's Oregon. So this is the gentleman that has connected with me in the past. I think he's been on a lot of my videos before. So he talks about velocity banking, infinite banking, and he'll do both, I believe. Index universal life and whole life. And to add to the marketing terms, he does, he calls it dynamic banking, right? So these are just marketing terms. I know me personally, I'll just use infinite banking often because it's, I would say, the most familiar, or become your own banker, right? So Oregon Cash Flow Pro. Then you have Garrett Gunderson. I don't want to type out his name. I want to make sure that's allowed, but I think the name of his YouTube channel is called Garrett Gunderson. But let me look it up real quick. Yeah, it is. So he calls it cash flow banking. Oh yeah, his company, there it is, Wealth Factory. So the name of his company is called Wealth Factory. And I like him a lot. I like his material. I've learned a lot from his material. I'm actually a client of Wealth Factory. So I am a client. I attend some of his private live streams, his Q&As. He's got a lot of material. I would say that his most attractive material is on taxes. Although he is not a tax person anymore. I think he is kind of like me. He has ties with a lot of people. He has partnerships with a lot of people. So, and that's kind of like how I like to operate. I think I recently rediscovered my true purpose in life. You know, I thought it was money, finances, right? Helping people with their finances, which it is a part of that. But after, you know, gaining experience doing a lot of videos and really being in touch with my King in the kingdom and the Holy Spirit, you know, the Holy Spirit revealed to me that my true purpose in life is like a connector, you know, a hub of information that can be curated, authenticated, and delivered to that individual in a process form, right? And so when I'm working with my clients, I'm doing more than just helping them get out of debt, although that may be the focus. Once I get them out of debt or close to being debt-free, then we implement, you know, infinite banking, you know, high cash value life insurance. Then we start talking about having a trust, a will. Then we start talking about building a business. Then we start talking about building business credit, right? And then asset protection. And then we start talking about 10X. Then we go into creating content that will perpetuate your kingdom and last forever. So taking people through an entire life process, and being that connector, connecting them to the proper resources at the proper time, you know, everything being in perfect timing, or, you know, doing my best. So that's where I kind of lie. So other players, we got IBC Global, Wealth Nation, just to recap, Oregon Cashflow Pro, Wealth Factory. You've got Banking with Life. Why does it keep going bold on me? So you got Banking with Life, and it's two individuals, one of which worked directly with Nelson Nash for a number of years. I think of quite a long time. If you look at his content, he even has content recorded with Nelson Nash himself. So not bad. And like I said, I'm just putting people on here that I feel like are credible, that have been doing it much longer than I have. You know, I'm 24, so I get a pass. Right? I started in this game pretty young. So, you know, I don't have the experience like some of these other gentlemen do. But that's okay. You know, it's only a matter of time before I, you know, keep learning this, keep practicing with this, and, you know, deliver that information to you guys. So you got Banking with Life. Who else you got? You got Bank on Yourself. That is with Pamela, right? So it's a marketing term, and it's the name of their company, right? And this one too, Your Own Family Bank. It's a marketing term, but it's also the name of their company, right? Then you've got, who else is in the game? And you guys can comment below, and I'll add to this later. I had a whole list. Let me think. Oh yeah, how could I forget? VIP Financial Education. So that's with Matthew Pillmore, but he is partnered with a individual, and I think he is Cashflow Ninja Pro. If I'm not mistaken, I think they have a podcast that they talk about, that he talks about and he refers them to. So I want to say that Matthew Pillmore partners with an agency kind of like the way I do, where he's not doing all of the policy designs himself because his specialty is more so in the credit building space, the real estate space, velocity banking, and educating. You know, I would classify him as a teacher more than a salesman as well. So here are the big players, and I know there's more. I'm forgetting one. Paradigm, did I spell that right? Shoot. I don't even know how to spell Paradigm. I ain't gonna do it. So it's Paradigm Life. Paradigm Life is another one. Paradigm. Is that right? Yes, it is. There we go. Had to think. Sorry. So, Paradigm Life is another player in this space. And guys, look at this. This is only a handful. Like, there's not hundreds of players, right? And roughly all of them do whole life, right? So Banking with Life, their whole life. Wealth Factory with Garrett Gunderson, he's whole life. VIP, he's whole life. Cashflow Ninja Pro, if I'm not mistaken, whole life. Bank on Yourself, I've never seen them talk about Index Universal Life in a positive way. So, nor Your Own Family Bank, whole life. Paradigm Life, I think they might do index, but I'm not sure. And most of these guys that I looked up, they're whole lifers, right? Cashflow Pro, he's the only one I know that does IUL and whole life. The players that I know that do IUL specifically, let's see, you've got World Financial Group, that's the name, so WFG, that's the name of their company. Who's the other one? It's that guy Patrick David has a YouTube channel. What's the name of his? Oh, PHP stands for People Helping People. Now, these two companies are in fact network marketing structures, or you could say multi-level marketing or direct sales. And they do sell whole life, but I think they push IUL a little stronger than they do whole life. Me personally, I've gone to PHP meetings, I've gone to World Financial Group meetings in person and online, and they typically push Index Universal Life designs more than they do whole life. So those are the players that I've seen so far. And there are more players, but I'm just letting you know there's not that many players that I would say are credible, right? I'm forgetting a big one. Shoot. The Nelson Nash Institute. So what occurred from Nelson Nash himself, after writing so many policies and probably hitting a point where there was more demand than supply, he created the Nelson Nash Institute, which is basically like a certification for life insurance agents that want to teach and sell the infinite banking concept according to how Nelson Nash did it, right? And if you read his book, he did it a particular way, right? And so if you go to the Nelson Nash Institute, you could literally look up an insurance agent in your area, and you'd get, sent to an agent that could, ideally design you a policy around, again, whole life only. So they only believe in the whole life product. I know there's more IUL players out there. The popularity is leaving me. I know there's another gentleman, I think he says Banking on Life or something like that I've seen. And then, oh yeah, there's another guy named Tom McPhee, but I don't want to brutalize his name. So he's another player, Tom McPhee, and I think he's a whole life proponent as well. Just talks about whole life. So these are the players, right? And when you're doing your research, they're either going to be whole life insurance agents, or they're doing index universal life, or they're doing both. Those are really the two most popular designs for high cash value life insurance. It just boils down to you coming to a conclusion on what you're going to believe in most, right? Or, based on facts and opinions put together, and then you decide, okay, I'm going to go with this, right? So first qualification for me is, finding a particular player that can show me this, that can teach me it. That player, I want them to be a salesman, a teacher, and a doer. They need to have all three in my book, right? They need to be doing it. They need to have their own policy. They need to be willing to share their policy with me. I want to see it. I don't want to see an illustration. I want to see the actual contract policy itself, right? And I want full transparency. I just want to know. I'm not trying to compare bank accounts, but I just want to know that you are in fact experiencing this and doing this for yourself, right? Then you've got the marketing terms that we went over so far. Okay. Now, the next thing I want to dive into, and then I'm going to reveal some of my stuff, is I want to go into really what you should have as the customer. What you need to have in place. So as you're doing research, you want to prepare yourself. This is not a simple product I put into place, right? This is something that ideally, if done properly, you're going to have it for your whole life. I mean, that's the idea. Would you ever stop saving money? No, you're going to always save money for your whole entire life. You're always going to, pay taxes for your whole life. That's not going to change. So what this concept is doing primarily is giving an individual an alternative to bank accounts, right? An alternative to checking, savings, and money market accounts and CDs. It's an alternative at its core, right? And at any time, keep dropping your questions. Hey, this doesn't make sense. Repeat that, and once I'm done, I'll go back and we'll go through it. So at its core, high cash value life insurance is in fact, if it's designed right, it's a tax-free savings plan, right? At its core. Has a death benefit at its core, right? Understand it is not an investment, right? Another marketing term out there is called investment grade insurance contract. I've heard that as well. Investment grade insurance contract. But the whole life product itself and the index universal life insurance product, right? If designed right, these things are not an investment. They're assets. Major banks, corporations have them as their number one asset class to stockpile cash, to prevent that cash from losing value. You need to understand, as an individual, all of your cash that you have in your wallet, at Bank of America, Chase, Wells Fargo, Citi, right? All that money that you have sitting in money market accounts, savings accounts, checking accounts, they're losing value every single day. Your purchasing power is being reduced every single day. Okay, so these are facts, not opinions. Every single dollar in the United States is debt. So even if you tell me that you're a debt-free individual, your money is debt. So what you have to understand as an individual is that the only way to make money now in the 21st century, in this economy that we live in, is through debt. You need to be able to learn how to use debt. Now you, and everybody watching, for the most part, you've been using debt your whole entire life to pay debt, right? You get a paycheck, you pay your bills, you pay your debts. Okay, you're using debt to pay debt. If you look at any bill, the 1, the 5, the 10, the 20, the 50, the 100, look at it very closely. There's little wordings that says this is legal tender for all public and private debts. So that means all of your money is debt. There's no argument there. These are facts. It's just a matter of how do you use the debt, right? Are you taking that debt and storing it in the dirt where it's going to lose value every single day? Are you putting them in sinking funds? Are you putting them in cash envelopes? Are you putting them in emergency funds where you're earning 0.00125%? Nothing, right? So these are key things that you need to know and that you want to have in place for yourself. Like what have you been doing personally, and how can you make the particular shift, right? So understanding where you stand financially. In order to do that, you need to know your 4 major numbers: your income, your expenses, your debt, your cash flow. So I'm going to share with you my numbers, okay? And this is a simple, dumbed down, this is dummy proof spreadsheet, right? It's as simple as they get. If you want something more complex that covers a lot of other things, I recommend going to VIP Financial Education's YouTube channel, and in their description of every video, you can download Matthew Pillmore's financial spreadsheet. It is way more complex, in depth, and it's very, very good. A lot of my clients actually use his spreadsheet because it's way more intuitive. There's a lot more boxes. It's cleaner. It's better, right? This spreadsheet is super simple, okay? All we're trying to figure out is your numbers, okay? Where do you stand personally? So these are my 4 major numbers. Income. Here's what I do is when it comes to income, I underestimate. If you're someone that gets paid salary plus commission, usually what I do is I look at that person's last year's income, salary plus commission, and I'll use that number even if they got a raise this year, right? And then what I'll do on top of that is I might take their salary from last year, their commissions from last year, and I'll decrease it by like 10% of their commission. So if they made 100,000 in commission, I'll take 10% off and say, okay, you make 90 plus your salary, right? Just to be conservative. I want to have room for buffer, for error, because there's emergencies and things like that that occur. So I underestimate income. I overestimate expenses, okay? And then, you know, whoever has debt in the house here, you list out all your debts accordingly. And then lastly, I underestimate cash flow. So you'll see in my videos, I'll be like, hey, so we have an individual making $6,000 a month. Their expenses are $5,400 and their cash flow is $400. That is mathematically incorrect, right? You would agree. No, their cash flow is actually $600. But what Denzel does is underestimate, because I like to underperform these concepts so that when the person actually gets better results, they build faster momentum. We created room for error in case there's an expense that comes up or anything like that. So this is just how I personally operate in terms of when I'm looking at these concepts, such as the infinite banking concept, high cash value life insurance, and how to position myself for it so that when I approach the agent, not only do I know all this information that I can refer back to, right? But I'm also putting myself in a position where once I come to the table, I'm not wasting that agent's time, that I'm asking real hard questions, trying to get to the truth as best as I possibly can, and then move forward. So those are the things that I would say you need to have in place. I say, hey, provide a spreadsheet, send your numbers to your agent, and they, if they're really good, they could formulate a policy based on your numbers. Right? So here are my numbers. Here's the breakdown of my income, right? Money going to different accounts, Roths, right? You put your personal business savings, right? I've got 2 policies, one with Mass, one with Guardian, right? Put all the things that you wherever you put your money at, right? And then show all your debts. Okay, me personally, I only have 1 debt, and that's for trying to build a stronger credit, so I'm not paying off that car. I went from a lease to a buy, so I'm just simply trying to pay off the car and build my credit a little bit stronger, because I'm looking to buy a home for my mom in 2021. That's going to be her gift that year. So, and then list out all your expenses, right? Be very, very accurate. And do things like this. Have a buffer, right? Doesn't hurt. Have a buffer. Let me see something here. Let's zoom in on this. You guys can see that nicely? All right? Put a little buffer, have a little miscellaneous, right? Put everything. What do you spend money on? Label it all out, right? Label out your giving, your tithes, your offerings, right? Anywhere you give money to. Look how I have 2 miscellaneous. Got household list of miscellaneous and then other miscellaneous. I'm creating so many buffers, right? So I don't actually spend, like, total says 95.73. I don't actually do that every month. Maybe once every now and then. But when you create those buffers, you remove room for error. So that's what I would say you need to have in place when you're talking to an agent. Okay? Now, going into policy design. Okay, this is the second component. High cash value life insurance. Let's say I'm a customer, I'm a prospect, I'm looking at this, trying to get educated. What are my options on designing a policy? Well, I've already broken it down for you, where we've got whole life and index universal. I got to decide between the 2. Based on the player that you decide to work with, they're going to steer you in one direction, and they will bash the other one. Or they'll just provide evidence, facts, resources, blogs, articles to support why they like index universal life over whole life, or why they like whole life over index universal life. So you as the client want to be aware of that. Hey, at the end of the day, this person is a salesman. They're trying to teach me what they're doing, right? If I like what they teach, if I like what they do, and I'm in sync with them, then I move forward. But if I want to, get like more information, then here's how you can dive a little bit further to identify that agent that you want to end up working with, right? So policy design is a major component. Your number one goal, I'm going to blow this up. Your number one goal is do not create a Mac. No matter what policy design you go with, you want to ensure that your policy does not become a mech at any point in time as you're funding a life insurance policy. What you have to understand as an individual is your chance of creating a mech increases the moment you decide to overfund a life insurance policy. Right? So no matter what you do, no matter what policy design you go with, no matter what insurance company you go with, the moment you overfund a life insurance policy, you are increasing the chance of becoming a mech. So what we do as insurance agents and what you can do as the client is understand mech laws, right? These mech laws are established by the IRS. Okay? The mech stands for Modified Endowment Contract. It's also a 7-pay test. So a easy example, right? Easy example. What am I doing? Come back here. Yeah. Easy example is if I'm putting 7K a year into a policy, I have to have a mech that is higher than 7K, period. Right? Based on the split, right? Based on the split of the policy will determine how much money I can overfund a policy with. Okay? So, give you an example. This is a in-force life insurance illustration based on the 2020 dividend scale with Guardian Life Insurance Company of America, based on a 23-year-old individual by the name of Denzel Rodriguez, right? Perfect health, male, started in 2019 is when this policy was established, putting in $70,000 a year into the policy is what I'm funding. My base premium is $7,000. Okay? So, in regards to the mech limit, right? When I'm funding a policy, whatever you're funding, money goes into two places regarding whole life. So let me be clear. This is a whole life policy, right? And with whole life, money goes into two places. Premium, right? Base annual premium, and then net cash value, or what's called paid up additions, right? So, when you're putting money into a policy, your mech limit is literally based off of the death benefit. You have to understand that the IRS is making sure that Denzel Rodriguez is not taking advantage of the tax-free advantages that life insurance has to offer. We want to make sure we're not taking advantage of it. The reason for that is because a lot of wealthy people, right, or just people in general, predominantly wealthy individuals, back then, many years ago, they were using life insurance as a means to stop paying taxes, to avoid crazy amount of taxes. So what they were doing was they were dumping millions, billions of dollars into life insurance, and they were not getting taxed anything, because you can't tax something that's not an investment, right? So life insurance, again, is not an investment, so therefore it cannot be taxed. This word dividend in insurance terms means return of premium. So that means the individual overfunded a policy, and then that company gave me a return of premium in the form of cash, what they call a dividend. And I can use that cash today, tax-free, to pay bills, finance things like vacations, equipment, tools, projects, mortgages, car loans, student loans, finance anything through here. Pay off debt, fund a business. I could write loans to my own business, not pay taxes on the loan, right? Because it's a loan. Just pay taxes on the interest gains. Pretty powerful. So understanding the more time you spend on this will help you determine whether your policy was designed correctly or incorrectly. Even if your policy was not designed correctly, there are ways to get out of it. There are ways to, prevent the policy from becoming a mech. So if someone has, in the chat room here, we got 97 people in the house. If you want to prevent creating a mech, right, and you get a letter in the mail saying that, hey, if you keep funding your policy like this, you're going to create a mech. Well, the way to avoid that is doing what's called a reduce paid up. Or you decrease how much you're overfunding that policy. Okay? So really spending a lot of time on the mech is going to help you come up with a policy design. Now, there's only so many ways to design a policy. And here are the ways right here. In terms of the split, right? So money goes to two places: cash value, premiums. Premiums, cost of insurance, cash value, PUAs, paid up additions, right? And then the other place that your money goes is fees, right? You've got term rider costs, sales load charges, annual charges, right? There's little charges here and there in all different types of permanent life insurance policies. So that's technically the third place that money goes. Now, when you put money into a PUA, which is in fact a rider, so the fee is in the cash value or is in the premium. So that's why I say it's two, but if you want to be technical, it's three. Riders do have fees attached to them. And again, these are all important to know as a customer. So, you don't get blindsided. Like, oh, I didn't know I had to pay this fee, that fee, this fee, whose fee, right? You're aware. The more aware you are as a client, the better the agent can serve you. The better you can decide whether that agent is for me or not for me. So in regards to splits, you can go as high as 90-10 according to IRS limitations and the insurance company. The insurance company limitation. So the life insurance company that you decide to go with has a limitation on their mechs. The IRS also has their own limitation as well. And it's usually in sync with whatever mech limit you have on that policy. So I can go as high as 90-10. This is an example of a 90-10 split. 70,000 principal going in, 7,000 base premium. 1090. if I were to do a 80-20, right? I'm putting, say, 70,000 a year times 20%. My base premium would be 14,000, right? If I went with 40% of 70,000, my base premium would be $28,000. Okay? Now, the moment we start getting into companies, policy design, and splits, you are going to either come to a conclusion of facts mixed with opinions, and then you come to a conclusion based on where you want to end up going, right? So you as the client, you want to be most comfortable understanding why your agent is saying to go with a 90-10, with a 80-20, a 70-30, a 60-40. Now, this is my personal opinion, which is backed up by facts and evidence, which I would say anything past 60-40, in my opinion, based on facts and evidence, puts you in the danger zone. What is the danger zone? Simply means that you are now stepping into traditional whole life insurance, where you're not actually benefiting from this word, high cash value life insurance. It's going to take you a significantly longer period of time to just break even on your money, right? Imagine if like you saw this policy right here, 70 grand, 7K base premium. According to the MEC laws, the insurance company's limitations, this is allowed. Current status, look at that, it says not a MEC, right? Not a MEC. So when you see this, and then maybe you're talking to an agent that says, oh, we do 50-50 split. So $70,000 times 50% is $35,000. Why on earth would you, the client, agree to give $70,000 of principal, right, and pay $35K in cost, right? I don't know why you would do that. Now, the only reason why an individual would do that is because they never saw a 60-40 split, a 70-30, a 80-20, a 90-10. They've never seen it, nor has the agent ever seen it done. It's just how they were taught. Now, what I'll reveal to you, and I'll show you an example, is the insurance agent, we make money right here. We get paid off the premium, which is the cost of insurance. Majority of our commission comes from the premium. So let's say I'm receiving a 55% commission based off of the premium. 35,000 times 55%. Right? If I designed you a policy where you're like, Denzel, I have 70 grand too. I want to throw it into a policy and earn money like you do. And let's say I don't show you my policy, but I design a 50-50 split design, and I say, yeah, here's how it works, and you know, your cash value is going to grow over a period of time. It's guaranteed to grow. You're going to get a death benefit and all this stuff. Everything is factually true, what I'm telling you. You're going to earn money, right? It's tax-free. You can use the money however you want and all this stuff. It's just not going to be as efficient, right? So me as the agent, oh, if I do a 50-50 split, 35,000 times 55%, My commission is $19,250, and that is just based off of the base premium. You have to understand, insurance agents also get paid off the PUA. So the other $35K that went into PUA, and you guys probably hear that car alarm, so forgive me. So the other $35K that went into PUA, we get, I want to say, roughly a 2% commission off of the other $35K that went into cash. So that's, roughly about $700. So Denzel would get paid roughly $20,000 or more in commission. One policy, right? Same exact policy, right? Let's say you went with this company, Guardian, and you were my age. Let's say we're the same age, same health rating, same funding amount, same company, same, everything is the same. The only difference is the cost, right? That's it, the cost. Denzel pays $7,000, whereas Joe pays $35,000. Why on earth would he do that? Well, it simply boils down to you doing your research, your homework, and coming to a conclusion based on facts and opinions. So if your agent believes that 50-50 is the best way to go, well, he probably believes that because he's getting a nice, fat commission, right? A commission for me on this policy is many, many, many thousands of dollars less, right, than $20,000. I probably get paid below $7,000 in commission, right? Because, again, we get paid off the premiums and the PUAs. So as an agent, the more premium I charge you, the more commission I will make. And that is a strong case to argue against in terms of why someone would do a 50-50 versus a 60-40 or a 70-30 or 80-20 or 90-10. So in my own personal opinion, the higher I put my premium, the more commission I, the agent, makes. You, the client, the more you pay in premium, the less cash value you'll have up front and long term. Now, here's the key thing to understand. When you're designing a policy, based on these numbers, not anyone else's numbers, but your numbers, if you come to me and you say, Denzel, I have $70,000. My goal, Denzel, is to pay $70,000 for as long as humanly possible, right? So notice how my policy is only designed to put in 70 grand for 7 years, right? If I do that, what I'm saying is after year 8, I'll only be able to put in a maximum of $28,000 according to the MEC laws, the insurance company's limitations, and the PUA rules of Guardian Life Insurance Company, of America. So, with Guardian, so where can I put that detail? Put it right here. So with Guardian, dependent on how you design your policy in terms of funding amount, right? So we'll create a new section actually. Let's just do that. We'll create a new section here. Nice and clear. We're going to call this section funding period. Okay? Funding period. way, create some space here. All right. Your funding period is very important. Your funding period will have an effect on your premium and your MEC limit. Okay? So looking at this policy here, if I was talking to an individual, if I was talking to a client, and I said, Denzel, I like your policy, you know, 70 grand for 7 years. Okay, great. But me personally, I would like to put in 70 grand for 50 years or 70 years or till death do me part, till the Lord calls me. Well, if that person wants to do that, they want the capability to do that, this premium has to increase. Now, I've only done this a few times because I think from a practical standpoint, I haven't come across too many individuals that are that committed to funding a policy for their whole life. Most people want to fund it for a period of time, maybe 10, 20, 30, 40 years, but they do not want to be strapped to a high premium for their whole life. So therefore they lower that premium in their costs so that they don't have to be obligated to do that. But so let's just say we did come across an individual. Let's say you're someone that does want to put in 70K for your whole life, right? Let's say you did want to do that. All right, well, the base premium has to increase. By how much, Denzel? So what I've seen so far based on age, health, and finances with some case designs is we would have to go as high as a 75-25 split. So you're putting in 70,000 times 25%. The base premium would have to be at least 17,500. That is to satisfy the MEC laws so that there's never a time where you will create a MEC in the later years of your policy. So the reason why policies become MECs is because the dividends of that particular life insurance company comes down, right? So maybe you were earning 6% or 5% dividend in 2020, but then in 2021 it drops to, from 6 it drops to 5.8. That could have an effect on the death benefit increasing, keeping up with the MEC limit. You have to also understand that every 7 years, your MEC limit will decrease. So that is why when we're initially funding a policy, we create plenty of MEC space, enough MEC space to support an individual trying to put in 70 grand for the whole entire life. Now, based on the company's limitations and rules, so for example, Guardian will allow you to pay in 70K for your whole life with a 75-25 because their PUA rule is you can overfund your policy by 3x the base premium, right? So in order to overfund any life insurance policy, you need to have a PUA rider and a term rider. You can either go with a 1-year term rider or a convertible term rider. Those are the different options that I've seen so far that Denzel has learned from other players. On my policy, I have a what's called a OYT, 1-year term. I have a 1-year term rider that only stays on for 7 years, which is my funding period, right? After 7 years, that term rider disappears. Notice how the death benefit drops a little bit, 3,834,876. Look at my face amount of 1-year term each and every year. It starts off at 2.325 million, right? Then it decreases to 1.8, then 1.4, then 1 million, then 600, then 180,000. I'm sure you can agree with me that the term rider cost on 2.325 million is higher than 600,000, is higher than 180. So what happens is my cost of life insurance actually decreases all the way to 0, where I don't need that term anymore because I put so much money in PUA, paid up additions. Paid up additions has a direct correlation to the death benefit. So look at this column right here. It says total amount, total face amount of additions. Face amount means death benefit. So what occurs is, or I should say this right here, cash value of all additions, my bad. So the difference between 7,000 and 70 is 63,000 minus my term rider costs and other internal costs of the policy. My PUAs buys me another, say, 125,000. I think I'm saying this right. It's either this column or this column. I forget how much death benefit it purchases me. But this is whole life, permanent. So I own this. Yeah, so that's what that means. Total amount of additions, base premium and cash. So I own 906,623 and I'm renting 2.325 million. Right? And then when you add it all together, we got this base face amount, 767,000. That's based off 7,000 of base premium. Put all these numbers together, I get that level death benefit of 4 million. That 4 million stays the same for 7 years. So notice how the term drops, but the PUAs and the base premium increases the value of my permanent life insurance. And then after the 7th year, notice how it doesn't show me putting in any more money into the policy, right, of additional PUAs. But it does show me putting in 7,000 consistently, right, all the way to age 95. This is a L95 policy, so it's paid up at age 95, right? With Guardian, remember how I was saying that we can put in 3x the base premium? So without having a term rider any longer, because that term rider is going to get more expensive later on in the years. So to avoid that cost, Guardian allows me to put in 3 times the base premium. Well, 7 times 3 is 21, so I can put in $21,000 above 7,000 for a total of $28,000 into this policy, right? So when you're talking to your agent, one thing, and we're going to put it over here, in what you need to have in place for yourself, is you want to have a total number, right? A total number to reach. You know, your goal number. So when I first started my policy, you know, I was like, I would love to be able to get in $500,000 in the shortest period of time possible. 70,000 times 7 is 490,000. I knew that according to my numbers, when you look at my numbers, my 4 major numbers, is that possible? Can Denzel do that? Well, I cash flow 15 grand a year. Times that by 12, what do you get? That's a lot more than 70 grand. So I could reasonably do that. No problem. It's practical. So you want to have a total number that you can reach. Well, my goal number was 500K. Now, that was the goal number. And then I left the window open to keep going if I want to without having a high premium to do so. Right? Now, I'm not against having a high premium. Not really against it. I'm just from a numbers standpoint, if I have a set number, a set goal, and I can do the same exact thing as that higher premium, say a 50-50 split, if I can do the same exact thing but end up with significantly more cash than the other individual, why wouldn't I do that? From a cost basis, why wouldn't I do that? It makes sense, right? And then if I leave the window open, I can do 28K a year for the rest of my life without a term rider. So that means that the PUA is a pure cash value dump-in, which also buys more death benefit. So the longer I put money into the policy, the bigger the death benefit goes. Notice how if I just put in $500,000, right? Total output is 490,000, right? For 7 years, right? Net outlay, right? And then it's 7,000 for all the way till I'm 95 years old. Well, notice how my death benefit at 94 is $10 million. Started off at 4, ended up with 10 million. That is a very, very strong kingdom for a young man, right? That is a very powerful way to perpetuate the Rodriguez family. Is that not? I only pay in $500,000, 490,000, and then 7,000 times however many years this is, right? So a little over $500,000, and I get $10 million back when I die. You can't go wrong, right? So when you're looking at your policy design, you want to pay attention to these things. So you want to have a goal number, and then you want to practically, you know, ideally leave the window open to keep funding a policy if you want to. You don't have to. If you can, you know, you don't have to if you don't want to. You're not obligated to such a high premium, right? Here's the other thing to keep in mind regarding the funding period. Going back to that 50-50 split. If my cost was $35K a year times 7 years, what does that equal? Right? 35 grand times 7. So I paid the insurance company $245,000 for a premium. Right? It's going to take me a much longer time to recoup the money in cash value. Right? And then after those same 7 years, the money goes down to 35 grand. So I'm paying 35 grand for the rest of my life. I'm strapped. I'm stuck to that base premium for life. This is important because if you're an individual that just says, Denzel, I only want to pay $70K for my whole life, or $70K for 20 years, or $70K for 10 years. Well, ideally, me as the agent, I'm going to design a policy based on that time period and then just leave the window to keep going longer without being strapped to such a high premium. The only reason why I believe I would set my premium to a much higher cost is because, in fact, you are full of conviction that you're like, Denzel, I'm going to pay this for my whole life. Then we have to set the base premium higher to the $17,500 because the PUA rule says that if my base premium is $17,500 times that by 3, which goes into PUA, right? $17,500 times 3 is $52,500. It's $52,500. So, if I'm able to put in $52,500 in pure PUA with a base premium of $17,500, add the two together, right? Add both, you get $70K. So that means that this individual is able to put in 70 grand for their whole entire life with the lowest premium allowed according to the MEC laws, which is 25% of the funding amount. And they don't have to have a convertible term rider or a 1-year term rider, which has additional, it's additional costs. So I don't have to have that on forever, right? I don't have to, pay so much in premium. That's the max it'll go. But if you're someone that says, Denzel, I don't think I have the will, or the desire to pay in 70 grand till I'm 95 years old. Denzel, I don't know. Alzheimer's runs through my family. I don't want to forget that I have to have that large expense. I don't want to have that burden over my family. Denzel, I don't know how long I'm going to be around, right? I don't want to try and have this crystal ball and, for the foreseeable future. Everybody has their own, case. So this is a situation, right? Case by case study that I would go through with every person and just letting them know, hey, I don't think we have to pay that much forever, right? That high of a premium. I don't think I should be strapped to that forever. All right, and so that's funding period. And then the other thing I want to close out with is really intent. And someone said that the screen is a bit blurred. Oh, you said it's better now. All right, perfect. Everything's okay with the screen here. I know modeling commented. Let me just get a couple more comments. You guys are good? You guys can see this nice and clear. If you want, I can blow this up even more. All right, so I'm going to close out with intent, original purpose, and strategy. When you're talking to your agent, what's the strategy? Why am I doing this? Why am I giving an agent so much money? What is the purpose? Looking at your own personal numbers, your 4 major numbers, you need to decide, what are you going to use it for, right? And these are the different things that I've been doing so far. So I already know that at its core, it's a tax-free transfer of wealth when I die. It's a tax-free savings account. I can use the money from my policy tax-free. I can offset high-interest debts if I ever get into debt again. I can offset annual expenses in my personal economy or my business economy, I learn how to use $1 more than once. I can finance my own projects, tools, luxury items, vacations, etc. I am simply recapturing my transactional business that I do throughout my life. That's all I'm doing, is recapturing the transactions that I make with Bank of America, with Amazon, with Netflix, with Hulu, with Chase, with the car dealers. I'm making sure that I try and get my dollars back to my economy first, and then I pull from my own economy to pay for the economy that I live in. Does that make sense? And then the last thing I'm going to close out with is agent accountability and infrastructure. Pick an agent that won't switch careers, loves what they do, they're knowledgeable, they're doing the concept, they're getting results, they're educated. They love it, right? And then here are some of the qualifications that I lay out that I like to see you have in place for yourself. You got to know your numbers, right? I prefer to see good income, good cash flow, 1,500 or more, good credit or debt-free or both, right? Are just some of the qualifications that I like to see. And that you personally study the concept, right? Willing to learn, right? You're coachable, right? I want you to ask 1,000 questions, right? If you work with an agent that after the 5th question, they start getting annoyed, I can't work with you, right? That's not fun. So I'm going to put it back to me here. Yeah, so if I'm working with an agent, right, and the first conversation, literally all they do is bash everybody else, and they say, I'm the only way. If they're playing Jesus, right, and they say, I'm the only way, right? The only way is through me, and through you, right? If they start preaching like Jesus in that form regarding life insurance, that's a turnoff for me, right? If you're not willing to give me all the information and be transparent about it and show my options. Hey, show me what a 90-10 policy looks like, a 80-20, a 70-30, a 60-40, a 50-50, right? Show me it all. Show me what it looks like to have a convertible term versus a 1-year term. Show me what it's like to go with a big company versus a small company, right? Like, when you get an agent like that that's willing to do that, it really helps you, even if you end up not believing in high cash value life insurance. That's totally fine. You know, I'd recommend you go invest in real estate. That's like the second best place to put money in right now for tax deductions, is through real estate. You know, opportunity zones and freaking tax lien investing and fix and flip, buy and hold, multifamily, Airbnb. You can't go wrong. You can't go wrong. So that's my lesson on high cash value life insurance. Let this be a base for you to kind of refer to when you're talking to an agent. Hey, if you want to work with me, right, and you want me to help you, I partnered with Ibc Global, which is one of the players in the industry. Now, typically, they stay around the 90-10 range, and they do whole life, right? And we typically work with the bigger life insurance companies, Mass Mutual and Guardian, but we're more than willing to show you a 75-25 split, a 80-20, a 85-15, right? We're more than willing to show you what a policy with a smaller company like Penn Mutual, or Lafayette, Mutual of Omaha. Like, if you wanted to see that, you could request it, because Steve Parisi is super nice, and he has access to go into the softwares of each insurance company. He holds an appointment, a license, the ability to carry all those carriers, right? And it's fun. All right, so this is just, being totally transparent with you guys. Hey, it's important to do your homework, right? All right, so we're going to go back to the very top, and I'm going to answer questions for like the next maybe 20, 30 minutes. I'm going to try and go as fast as humanly possible. And then what I'd like to do is, take a phone call from you guys because I want to try something out. Ecamm just dropped interview mode, and it's in beta, so they gave me access to it early because I use their product a lot. So, first question. What strategy, ideas to put more money into the policy? It is based off your age, health, and finances. So, depending on how much money you bring in, depending on your health and your age will determine the multiplier. I forget the formula. You could go to Ibc Global. He has a video on this where there's a multiplier of how many times your age to your death benefit you can get in death benefit. There's a multiplier. Based on like your income, your age and health, finances will determine how much death benefit you can get into a policy. So obviously the higher the death benefit is, the more capability, the more money I can put into a life insurance policy. Okay, so hopefully that answers your question there. What's the best strategy to tap into my 401k? You have the 72T rule. There's another rule I forgot. You've got the COVID stuff going on right now that you could take advantage of, which wouldn't hurt. Amanda says, how long does it take to start the policy? Roughly 2 months, about a 2-month stretch. And that is due to COVID. A lot of shutdowns, people working from home, and just the shift in the economy right now. Modeling says, I just got a quote for $25,399 base from Mass Mutual. $13,142 for the base premium. The LISR is $7,046. The ALIR is $5,000, and $200 for the waiver of premium. Is it too much going towards the base? Well, this is going to boil down to a position of facts, evidence, and opinions. I just showed you my policy. If I'm healthy enough to get the 90-10, ideally that's what I'm going to go with. It's the least possible cost, right? I don't see why do I need to pay more for the same exact product? So modeling, if you're saying, hey, Denzel, I have $25,399 a year to give you. Just take the multiplier of the different splits. Well, I know the lowest I can go is roughly 10%, $2,500. So I can bring that base from $13,000 all the way down to $2,500 and put in the same amount of money as you for roughly the same period of time. What you need to find out is how long can I do $25,399? Because if I can only do $25,399 for 10 years, which is what's called a 10 pay, why on earth would you pay more for that? I can tell you that your chances of creating a mech decrease significantly if you're only going to fund your policy for a period of time, right? Because look at modeling. If she goes with this policy, $25,000 with a $13,000 base, right? Understand that what if she designed a policy where she's putting in that same $25K with the same $13K base and has the ability to put in $130,000 in any given year for maybe the first 7 years or the first 10 years. She may not be able to put in $130,000 at first, but could she potentially give herself the ability to? I don't know. Depends on her age, health, and finances. But why pay more, right? That's all. Just ask yourself, why pay more? The argument is that the agent will say that, oh, this design, you're going to get a stronger guaranteed dividend on your money. My argument to that is, look, I mean, all these life insurance companies practically give the same dividend rate, between 4 and 6%. It's nothing crazy. This isn't going to make me a millionaire overnight, right? Investing in real estate will. 10xing my business will. Investing in Forex, gold, crypto, silver, currencies, stock market, right? Inventing something. That's going to build wealth faster. This, the way I interpret the infinite banking concept, is a way for me to preserve my wealth, preserve taxes, especially if I become a multi-millionaire and I have a large estate. I'm going to have estate taxes to worry about. This is where this would come in the end, right? So, you know, review it. Ask the agent, hey, could you do a 1090? And see how long we can go and compare it. Just match them up and see which one you want to go with, right? Good morning. Thanks to your advice on Velocity Banking, paid both of my vehicles in 4 months, upping my cash flow to almost $900 a month. That is insane in the membrane. Love it. By the way, it's a 20 pay. Okay, so she's paying $13,000. I'm going to round it down, times 20 years. That's $260,000. I know that with a 20 pay policy, I could do the same thing as her, 25K, with somewhere around 2,500. Call it 3,000. 3,000 times 20 years is $60,000. $13,000 times 20 years is $260,000. So I pay $200,000 less in base premium, and that money goes to cash. And then if I went with a company like Guardian, and I can put in 3x the base premium via my PUAs, well, 3,000 times 3 is 9,000, so 25,000 drops to 9. I could put in 9,000 plus the 3, so 12,000 for the rest of my life without a term rider, without having to start a second policy when I'm older, less healthier. Right? Amanda says, which companies do you recommend starting a policy with? So, me personally, I have a policy with Guardian and Mass Mutual, and I am extremely happy with both. Right? I have been considering opening a policy with Penn Mutual because it's simply one of the most common companies that insurance agents use out there. Penn Mutual and Lafayette are very, very popular in this high cash value life insurance space. So what I was planning on doing was finding me a player, giving them my money, 10 grand according to how they design it, and I'm going to match it up to my policy. Right? I'm just going to give them 10 grand and just match it up. I'm going to look at the net internal rate of return of that specific company, and I'm just going to do a little track record. Do like a 10-year pay or a 20-year pay and just see the track record. And go from there. Me personally, I haven't made sense of going with a smaller company just yet. You know, I'm open-minded to it. My issue is I haven't found a player that's willing to design me a policy based off of a 90-10 split. All they want to do is give me 60-40 or 50-50 splits. And I'm like, why would I do that? I'm an agent myself. I could write the policy myself and keep the commission for myself, you know? But I personally, I want to build relationships. I want to build bridges with other players. Instead of bashing other players, I just want to build a bridge. Okay, hey, I know there's some people that aren't going to like me. I know there's people that are going to like them, right? And it looks like my screen just went blurry for some reason. That's weird. We need to fix that. Let's see if it fixes if I just go like that. Oh, man. Is it because I moved? I think so. I'm going to have to fix that. Let's see, I'm in the process of buying a home. How will this impact positioning for velocity banking? How long should I wait? If you're regarding to the infinite banking concept, getting a policy doesn't affect your credit score, okay? It's just a matter of your four major numbers. Can you sustain the policy? Can you afford it? Terrence says, I successfully started a policy in June. I use your info to contact them. Already pulled a loan to do infinite banking. Also just opened my HELOC. Now I'm doing both infinite and velocity. That's awesome. Should you keep term life insurance until you save up enough to have same death benefit within the new whole life policy, or is there a way to set it up to have it immediately? Depending on your four major numbers, your age, health, and finances, in most cases, I usually do not tell my clients to kill their term policies, especially if they're super cheap and maybe it's a 10-year term and you're in your 5th year and it doesn't cost you that much. I usually don't say to kill it. Let's see. Hey, Denzel, it's John. I got my policy started a few months ago, age 25K a year for 10 years. Wonderful. Simple, straightforward. Recently started a policy as well, loaded it with 10K. Wonderful. Wonderful. Let's find out. What is a MAC? All right, we already answered that question. Does term rider make a difference? Term rider gives us the ability to put more money to overfund a policy in the beginning years. So that's the argument to the other side, which is why they give you a higher base premium. The higher the base premium, the higher the death benefit, the more money you could put into a policy. But it costs more to do it that way. With a lower base and a term mixed together, when you blend it together, it gives us the ability to do the same thing but for cheaper. Especially if you're only going to pay it for like 10 years or 20 years. So I'm with having a higher base premium if you say, Denzel, I want to pay this for a very long period of time at that max amount. And the most we have to go is 75-25. All right, that would be the most. But I don't have to go as high as 60-40. I don't have to go as high as 50-50. I don't need to do that. That would cost me too much. Okay. I have a 10K line of credit deposited, 43K of a 40K mech with an inflated mech of 62,000. Cash value 28K with 12K in a standing loan. Pay down debt, still 10x. Do I pay on loan or fund cash value? Ideally, I like to max fund first, then pay my loans later, ideally. Because as long as I keep max funding, I'll stay ahead of the loan interest that accumulates in the policy. And then when it's all said and done, when I go to pay back the loan plus the loan interest, it would have no effect to the cash value performance in the account itself. And that, helps me. I'm going to see if I can briefly fix my camera because it was being kind of funny. It's being blurry. So let's see if it works now. There you go. We fixed it. It was a little blurry and now it's not blurry. Thaddeus, I got a quote from Lafayette. The cash value started matching my contributions around year 9 to 10. Is that normal for IBC Global as well? Generally speaking, no. So if you look at my policy, so let's share my screen again real quick. Notice how my break-even point is way before year 9. Right? It's like around here. So I generally, between years 4 and 7, if you do a 90-10 split, is when you would ideally break even. If you have a 80-20 or a 75-25, then yes, maybe like year 9, maybe 8, maybe 10 is when it would break even. So again, depending on how you design your policy will determine that break-even point. The break-even point is important, but it's not as important as your ultimate goal of how you're funding the policy, right? If you're only funding it for a limited period of time, like a 10 pay or a 7 pay, 14 pay, 20 pay, yeah, you want to break even as early as possible so we have more money to work with outside of the policy, right? I have a policy, Mutual of Omaha, any chance I can use it? I'm sure you can. I'd reach out to the agent that originally helped you and get an evaluation. I would ask for an in-force illustration. I'd ask for the MEC limit. Hey, how much cash value? How much can I overfund this thing? How can I use it? How flexible is it, right, with loans and things like that. Carmen and Darius are awesome as well. Yes, they are. How do I decide how much to invest into a cash value policy to get started? 57 years old, I was thinking my cash flow times 12, 20 grand, which is ideal if you're debt-free. If you're not debt-free, I may not go as high as that. I might use 66% of what you have in cash flow per year. But, looking at what you're capable of doing, age, health, and finances, we factor all these different things to practically put a policy in place. If I only have 20 grand to work with and I'm in a bunch of debt, I may not be positioned yet for the infinite banking concept. I may want to do velocity banking first, or I may want to do debt snowball first, remove some debts, maybe 10x my income, double my income, and put me in a better position, right? Let's see. Yep, I know, screen was blurry, but it's no longer blurry. Got that fixed. Let's see. Robert says, looks like a great list. Yeah, definitely. I mean, these are players. These guys have been around longer than I have, so they have a credible reputation, right? So whomever you end up going with, as long as they have an infrastructure, meaning that I can call whenever, I can email whenever, I can have a conversation, I can go over my policy, I can get an in-force illustration, I can get some strategy planning tied to it. I kind of compare it to, pastors of the 21st century. You can't just be a pastor anymore, right? Back then, it was okay to just be a pastor. But now, the congregation is like, what else do you do other than pastoring? Like, can you do my finances? Can you do my taxes? Are you a lawyer? Are you an attorney? Like, you need to have, an arsenal of tools. If all you are doing is just spreading the word, but there's no strategy to the word, there's no actionable steps to the word, then, you're just throwing a bunch of words out. It may land, it may not, but I don't know how much your congregation is going to succeed if all they're coming every Sunday is just getting the word. That's it. I think you need more than word, which is faith. You need works tied to that faith. You need a plan. You need an action plan to be able to understand that word and comprehend it accordingly. All right. So can you not call into your current insurance provider like State Farm and ask for a whole life insurance plan? Sure you can, Amanda. The problem is majority of the agents in-house are not taught everything I'm telling you right now. They're actually taught to design policies as a 100% split. That means nothing going to cash, everything going to whole life insurance. So if I told you 50-50 was bad, and that's the danger zone, can you imagine what 100%? Imagine giving $70,000 to State Farm and having $0 show up in cash value the first year. How upset would you be? I'd be pretty upset, right? And that's part of the design, right? So I'm going to share my screen again here. So imagine freaking paying 70 grand and having like 70 grand all here, base premium with State Farm. That would suck. That's not fun, right? So I don't think you want to do that. That's why you have to search on the internet. It's like calling Bank of America and asking for a personal line of credit and how to use it. They're not exactly going to know how to use it for velocity banking. You can't call Bank of America directly and say, hey, I want to do velocity banking. Can you show me how to do this? They're going to look at you with 3 heads and be like, what are you talking about? They don't know about that. What about Fidelity, Guarantee Life, whole life insurance? Hey, I don't know. My education stops after the 4 major mutual life insurance companies. Mass Mutual, Guardian, New York Life, Northwestern Mutual. My education stops after that. I know that every whole life insurance agent, all the players I mentioned, they all agree to go with a mutual life insurance company, not a stock life insurance company. They all agree to go with a mutual. So I know I had put some notes here. If I share my screen again here, and I'm just going to take a sip of water. Excuse the noise. The background, they're doing some construction. So let me see. Got all these notes here I was taking earlier. Where did I put it? Darn it. I don't know where I put it. Company design. Oh, right in front of my eyes. So I would take note of that. Most, if not all, players that I mentioned above agree to be with a mutual life insurance company over a stock life insurance company. And they say you want to be with a company that's over 100 years old because it'll show financial strength, performance, longevity. You go with a stock company, you have to understand when they make profits, they have to pay the shareholders first, then they pay their bills and expenses, then they pay you, the policyholder. But when you go with a mutual life insurance company, they are paying you first because you are an owner of that insurance company. You're an owner. And that's why they pay you a dividend. So that's what I would say to that. All right. Charles says, what about Guardian? I own Guardian, so I love them. I got them. Thank you for the information. Love it. Oh yeah, money multiplier. Cash flow tactics. Love it. When it comes to IBC, what's the difference between whole life and universal? So with index universal life insurance, money goes to premiums, cash value, and then it also goes to additional fees where your money grows in an index account in the stock market. Now, the issue is regarding net internal rates of returns. There is a higher chance of creating a mech. So remember how I said the number one goal of designing any permanent life insurance policy is to not create a mech. Say, for example, you're putting in 70 grand a year into an IUL. I'm putting in 70 grand into a whole life, and I have a 50-50 split. So it's a terrible design. right? And I don't know it. It's a terrible design, but it'll never mech out. Versus the person that has a 70K design and it's like an 80-20 split, and it mechs out when the person is 75 years old. That is detrimental to that person's finances if they mech out. Versus me, had a 50-50 split, right? Terrible design, but I never create a mech. My money grows guaranteed consistently, although not as fast as it could have been, but still it's growing. And it's tax-free, stays tax-free, never mechs out. I can use the money forever and not have to worry. With IULs, they have historically, they have a track record of meching out, which makes it a dangerous product. So I'm going to give you a personal experience. Personal experience. Denzel went undercover, okay? I joined World Financial Group, WFG, because I want to see their infrastructure. That's how I am. I ask questions. But it's so hard to ask questions in the financial world when you're dealing with lots of commissions, lots of money payouts. A lot of people don't want to reveal the information, okay? So me personally, I got a policy designed through WFG using Pacific Life, which is an IUL driven, I would say, company. They do whole life as well, but primarily they selling IUL policies. Okay. I had them do a match for match on my own policy. And I saw the premiums were much higher. The mech limit was roughly the same as mine. There were tons of costs involved in it. And I have a video where I broke this down inside my master class for my clients. So, you know, you guys can view that. I was going to post it later on once I've edited, got more information. But through my own personal experience, when I seen the IUL performance, it illustrates a better performance than whole life. And it should, because it's saying that it'll earn 15% returns, 25% returns. But the problem is that the illustration is based on those rates of returns. If there are multiple years where I do not get those rates of returns, I run the risk, I increase the chance of becoming a mech in the later years. The other thing you have to understand is when you're funding an IUL policy, the cost of an IUL does increase over time. This is a fact. It does increase over time because they have term rider fees and they have annual fees. There's a difference between a flat fee and an annual fee. So IUL charges roughly, I'd say, between 1 and 2% maybe in annual fees. I think with Pacific Life it was like 1. And 1% on 1,000 is X. 1% annual on 5,000 is higher than the 1,000. Would you agree? So the more money that goes into that IUL, the higher my internal cost goes, right? That puts a hinder on my cash value, number one, but it also puts my policy at risk of becoming a mech. And like I said, the number one goal is to not create a mech. So even if the policy performs great, which I'm sure IUL policies do perform great, what I've seen in WFG personally from a higher up in the company is what they do is they'll convince you to do a 1035 exchange into a new policy to avoid that mech. Well, why would I do that? Why would I convert my policy into a new policy to avoid a mech, right? Like that doesn't, I'm gonna get a little scared there, because if I do that, I restart the cost of that new policy. You have to understand that the beginning of any permanent life insurance policy, you have these initial costs in the beginning of any permanent life insurance policy, whole life and IUL. Once we break past the beginning years, the policy becomes cheaper, less expensive. You get past all those beginning costs because the insurance company is overcharging us for life insurance in the beginning years. So if I keep doing 1035 exchanges into a new policy, I'm restarting those beginning years. So from a longevity perspective, IUL becomes a little scary to me, although I'm considering starting an IUL policy, putting in a very small amount, like $6,000, just to see the track record. Will that stand the test of time without doing a 1035 exchange? If I am encouraged by my agent to do a 1035 exchange, I'll know that it's because that policy can in fact become a mech at age 89, right? Or 85 or 70. It may not become a mech anytime now, but if it becomes a mech later on when I actually need it, that's not sweet. The other thing I've noticed in the WFG philosophy is they teach people how to put 10% of their income into these IUL policies. So you're saving 10%, got it. And then they show you how to take out withdrawals. Now that blows my mind. Why would I take out a withdrawal? It's kind of like withdrawing from your 401k. If you pull money out of your 401k, you're no longer earning interest, rates of return in that 401k. In a life insurance policy, when I take out a loan, it does not affect my cash value performance. But if I take out a withdrawal, so if I have 70K in cash value and I take out a withdrawal of 30K, I'm no longer earning interest on that money. Why are they telling me to do that? That is alarming to me. Why are they telling me to withdraw cash as a means of a stream of income? That doesn't seem too hot to me. If I do that, understand I'm forfeiting a higher death benefit performance because the cash value is no longer earning. So if it's no longer earning, that means my death benefit is no longer increasing. So I may end up with a lower death benefit. I don't like that philosophy. It doesn't match with my kingdom perpetuation plan. It may match for others, but for me personally, it doesn't match with my kingdom philosophy. So I don't enjoy that. Oh, I forgot to add, yes, sacred account. So that's another terminology. That's another player, friend of mine. I can't believe I forgot him. So let me put him on the list. Can't believe I forgot him. Sorry, Jerry. My fault. I'll put you higher up. So we got wealth dynamics, and they call it the sacred account. Pretty cool. They call it the sacred account. And I've done business with them as well. I'm a client with Wealth Dynamics. I like their mentality. This is very interesting that we need a third party to build the plan. You do. What if the policy is not the right fit and you need to cancel it? You have a 14-day or maybe 30-day what's called a look-free provision. So you could cancel the policy at any time after initially funding it, within like the first 14 days. It's called the free look period. Okay? Now, Amanda, to be clear, a third party, we're not, so like if I call State Farm directly and you say you want a whole life insurance policy, they're going to put you in contact with a licensed insurance agent, okay? That is brokered, that has an appointment, that is appointed, that's appointed with State Farm. So it's not a third party. It's not like I'm going to, a separate broker that does business with State Farm. No, you could go that route. The problem is that agent is not going to have the education around how to design a particular policy. So I hope I was clear on that. So you have what's called life insurance companies. In a life insurance company, they have departments, okay? One of these departments are called agencies, right? State Farm has a dedicated agency where the agents that are in that agency only sell State Farm life insurance policies. They are what's called captive agents. They only sell State Farm. Then you have other agencies, like the people I named on the list, that are called non-captive agents, meaning they can do business with State Farm, with Geico, with Mass Mutual, with Fidelity, with Mutual of Omaha, with Mutual Trust, with Guardian, with New York Life, with MetLife. They are appointed with all of the different carriers, say 30, 40, 50 plus carriers all around the United States. That doesn't make them a third party. That just gives them the ability to sell multiple policies to different people, because different people want different things. There's no person on planet Earth that has a copy of themselves. So I'm different from you, Amanda Parker, right? Your name is Amanda Parker. My name is Denzel Rodriguez. So we have different personalities, different this is what makes us unique. So if there was only one company, it kind of makes us like, it limits our options. And I like to have options, right? When I'm doing my finances. Okay? Hopefully that's clear. Very, very clear. Andres says, once you take out a loan, do you have to pay that back with premium? No. Your premium is separate from your loan. Okay? Premium is separate from the loan. You have a choice whether to pay that back early, later. You could never pay it back if you don't want to. All right, what I want to do real quick, I just want to test this out. I can't believe we're 2 hours in. 86 people in the house. You guys are just really committed to getting the information. I love it. I really do. I want to bring a guest. How do I do it? Darn it. I was trying to do it, and I don't know how to do it. It's like an interview mode, and I can like bring people on. Let's see, camera. Let's see. You know what? We'll just have to do it another day. I gotta learn. I'm gonna keep answering some questions. I'm gonna go to like 1:55. I have a call at 2 o'clock. So I gotta skedaddle. Modeling. My insurance agent tried to tell me that only businesses use this type of plan, but I know better. They are very convincing. It has me second guessing what I know. Yeah. Here's where my knowledge stops in regards to how businesses use these types of policies, right? So there's something called private placement life insurance. This is something that I learned. Private placement life insurance. I learned this word from Tony Robbins. He has a book called Money Master the Game. It's the size of the Bible, right? It's very deep. It's like 700 pages long. It's no joke. All about money. And towards the end of the book, he talks about private placement life insurance. So what businesses do is a business will establish their own life insurance company, pay the premiums, and get a write-off. Now, the individual has to have a net worth of, I would say, 5 million or higher, and you have to have, I think, at least 1 million of revenue per year to start this kind of an account, right? So obviously if a business were to do this, they get write-offs on the premiums. Another term for this concept is called key man insurance, bank-owned life insurance, corporate-owned life insurance, okay? These guys get to do what your average Joe cannot, because average Joe does not have that kind of wealth, right? So in the meantime, you can create a personal life insurance policy, not a business developed policy, right? You start in the personal side, and then should you decide to 10x your income, then maybe you want to look into this realm of private placement life insurance, corporate owned, key man insurance, bank owned life insurance product. That may be something that you might want to look into. But until then, I don't know how many people are going to make that kind of money. Okay, the average Joe does not have the knowledge to make that kind of money. Even if you do make that money, and when you do make that money, I promise you, you're going to come across individuals that are going to talk about that. So, I mean, once you get to that level, there's certain information that just comes quick. There's no issue. Okay, dividend that you earn, do you have to pay taxes? No, you do not. You do not pay taxes inside the policy if it's designed correctly. If you create a mech, yes, you will have to pay taxes and penalties. Okay? Let's see. Sharonda, how long do you have to pay into the policy before you are allowed to borrow? So when I funded my 2 policies, I took out a loan within the first 2 weeks. So you do have access to your money basically like day one of funding it. You set up your account, you download the apps that the company has. MassMutual and Guardian, they have an app. You have your online portal, you see your information. Once the money goes through, it recognizes, you can start the loan process. You call your agent and they can help you with the loan process. You can either do a direct deposit or you can take out, have it a check sent to the mail, which takes longer. I don't recommend it. I'd rather do direct deposit right to my account. Takes like 4 days or less. Hi Denzel, are you putting your whole pay as the yearly premium, $70,000, and withdrawing expenses, $39,000, to maximize the policy benefits? In a way, yes, I am. So we'll close out by sharing some updated information on my policy. Okay, so this is Guardian. So the person asking the question, I'm in my 2nd year. I've got this much in outstanding loan. This money is including the loan interest. So loan interest plus the principal I took out, it's at $73,150. Right? Notice how my cash value says $129. When I pay back everything in full, by the end of my 2nd year, I'll have around this much, $131,000. Okay? So I'll have about that much. So what I do, and I explained this last night to a group of women that I had a nice conversation with, is I save $30,000 a year. I have $40,000 worth of bills that I know I'm going to spend money on. A big portion of that is taxes. And then I have $20,000 of known bills each and every month that can be paid with a credit card. You know what I do? I switch all of those bills from monthly to annual to save money. So my actual output is more like $18,000. So there's already a $2,000 savings there. I then run it through a credit card where I'm getting 1 to 3% cashback rewards, either through a credit card or multiple credit cards. And I'll get about roughly this much in cashback rewards, plus statement credits. You know how when you first open a credit card and they give you $200 in the first 90 days if you spend $4,000? Well, I could do that amongst 4 or 5 cards and get like 200, 300, you know, in credit from the credit card company. So I have a net savings of about $2,500 or more just from the credit card, switching from monthly to annual, right? Off money I'm gonna spend anyways, right? This is money that's leaving my economy every year. 40 grand of known bills, right? Is money that is going to leave my economy no matter what. It's how I live, right? So what I do is I take that 40 that I'm gonna make and the 30 that I stacked away equals 70. I throw it in the policy. Once I throw it in the policy, right? I take out a loan. Goes back to my personal checking account, which will sit in a high yield savings account for a period of time. Slowly but surely, I will pay off the credit cards before the 0% offers expire, right? And I don't pay back my loan. So I got $39,000 in loans in the first year. And then now we're in year 2. I'm up there. It still says I got $129,000 in cash. So nothing happened to my cash, no matter what they charge me in loan interest. And we can look at the loan interest rate for my policy. So Guardian has charged me a 5.66% rate. Here's the total interest for the year. Whatever I pay in interest will be less than what I earn for the total amount of cash value that's in the policy. So I have a net positive borrowing cost. Net positive borrowing cost. Same thing for my Mass Mutual policy. Oh, Mass Mutual, what are you doing? All right, so they're doing probably an update right now. It's being a little funny. Well, let me try again. Maybe it's because I had the window open for too long. Oh yeah, that's what it was. They shouldn't be doing no updates during the year, during the day. So look, this is a smaller policy, putting in 15 grand a year. I've got a loan out for 11,000. Here's the total interest, 5%, right? But I'm earning 6% on the entirety amount of cash that is in there. So it has no effect to the amount of cash that I have in there, right? And I can still take out more money if I wanted to. If and when I decide to pay this loan back, no matter how much this compounds by, I'm going to continue to earn more and more net cash value on the entirety of the $8,286 and then the $11,000 principal that I took out. So I've got 18,000 plus in cash value. And I got 11,000 in loans. Has no effect to my cash value performance. I take this 11,000 along with this 70,000 plus, and I start running damn near everything I possibly can through the policy. And so I'm funding policies via money I'm going to spend anyways. And then I use my savings, right? My 30 grand, I use my savings to cover the base premium cost, the 7,000, and then Mass Mutual is a $1,500 base premium. So I'm paying 8,500 in premium, and I'm putting in 85 grand a year total. My cash flow is 180 grand. So I'm putting roughly 50% of my cash flow into life insurance. But technically, I'm not even paying in 50% of my cash flow into life insurance. I'm actually much less because 40,000 of that was bills. So this cash flow is actually sitting where? Sitting right here in the business checking account, right? I'll blow this up. Sitting right here. And then I deploy this money when it's ready to be deployed. I deploy it, right? The reason why I keep so much available is, hey, what if I get sick? What if I lose the ability to talk? Then my business shuts down, right? And if I can't support 70 grand a year, well, I can go as low as 7K. Or I can keep funding the policy for multiple years on end because I created the room to do so. Which is why it's so important to know your numbers, know how you operate, know how you function, so you can achieve the results that you want to achieve. Worst case scenario is you design a policy that is a small policy. Worst case scenario, you start a second one when you're good and ready, right? And we'll close out here. All right, we'll close it out here. I hope this was extremely helpful to you guys. Let this be a base. I'll do another live stream where we pick up, and I want to bring in people next time so we can have some fun with this, all right? I'm going to let you guys go. God bless. Enjoy the rest of your day. Keep watching the videos. Keep educating yourself. Stay engaged. Be blessed. Talk to you soon.